Welcome to this new episode in a series of online events run by Nickel Digital Asset Management, where we discuss financial logic and critical considerations of allocating to the digital assets market. My name is Anatoly Crachilov. I'm a founding partner and CEO of Nickel Digital, and today I'm joined by David Shrier, Professor of Practice at Imperial College Business School and Assistant Fellow with Said Business School, University of Oxford. At this event, we'll be addressing concerns investors usually face when contemplating initial allocation to this new asset class, how to securely hold crypto assets. We'll focus on identification of single points of failure and on the recent advancement of cryptographic technology to address these risks. Enjoy the conversation.
Good afternoon, everyone. Thank you for joining us for this online event. I'm joined today by David Shrier. David has spent his career learning and understanding how technology can shape a more positive world. David holds a dual appointment as Professor of Practice, Imperial College Business School, and Associate Fellow with Said Business School, University of Oxford. Previously, David was a lecturer at MIT. He has consulted Fortune 500 companies, including GE, Walt Disney, Verizon, and many others. He has advised government, including European Commission, on commercialization of innovation, and has engaged with OECD, Bank of England, FCA, SEC, US Treasury, on innovation opportunities, digital identity, and blockchain and AI. David is also an author of several books, including the recent Basic Blockchain. And there are a new book coming, I believe, David. Welcome to this conversation. Over to you. Perhaps you can give us a deeper insight how you arrived to this space, the whole blockchain and crypto.
Great. Thank you, Anatoly, and thank you all for taking the time to say hello. I mean, my journey to blockchain was by no means inevitable. If anything, I was a resistor, but it kept getting pulled into it until finally I gave up, I gave in, and participated, and now I'm doing my best to help build the sector, serving on the board of Copper Technologies, among others. But it all started back at MIT, which has been one of these nodes or nexus points of the blockchain revolution and our contemporary blockchain revolution in particular. And so if you look at blockchain, even the core technologies, some of them were developed at places like MIT many decades ago. What was clever about Bitcoin and about blockchain was putting together these technologies in a new way, and then hitting a moment in time where there was real interest in adopting it. My first exposure was in like 2013 or so. I was asked to help organize a conference that with Sandy Pentland and John Clippinger at MIT, which ended up helping prevent the US government from regulating Bitcoin out of existence. So we got together about 90 people from industry, blockchain hackers, wallet purveyors, people from government, people from academia, and we kind of had a shared conversation about what was going on and what was important. And out of it, basically, the wallet, all 22 at the time wallet providers agreed to adopt basic AML KYC standards, and this self-regulatory action then caused the U.S. government to step back and say, "Okay, we're not going to close it down. Now that we've actually met some of you and talked to you, we realize that it's not all, Silk Road people, selling kiddie porn. There's actually legitimate business uses for blockchain that can help transform the financial services industry. And so we'll let this play out." So a very enlightened perspective at the time by the regulators and supervisors. But I was still sort of holding back. And then I'm there in my office at MIT. I was working on a bunch of different things. And this student came into my office and said, I just started the MIT FinTech Club and 150 students signed up in a week. How come we don't have a FinTech startup class? And why aren't you teaching us about blockchain? And I was standing there with a colleague and I said, well, I don't know, I'm busy and he's teaching 6 classes next term, so we really don't have time for it. and she refused to leave our offices until we agreed to teach the class. So this is Meltem Demirors, who some of you may know. And she now has 100,000 Twitter followers as a leading light in the blockchain industry. But Mel was a student then, and she just refused to take no for an answer. And the rest has turned into this amazing journey in fintech revolution.
All right, perfect. Well, interesting story how I met David. That happened, I think, exactly 3 years ago when David essentially created and led the very first blockchain strategy course at Oxford University. And I happened to be in the first cohort of that student body. And since then, David and we knew each other. My personal story, I've been in blockchain for the last 2 years. But prior to that, I've been for 7 years with JP Morgan and Goldman's before setting up jointly with my partners, Nickel Digital. And when I was at GS, the whole crypto story came across my desk because many clients were coming with the question, we're not exposed to this, if we can call it a new asset class, but what are we missing? Do we have to be there? And that led my personal interest towards digital asset space. I went back to Oxford. That's how I met David. Went through this program, which to some extent became a point of no return. And I realized, however small is digital asset space, it's likely to be the fastest growing part of the entire financial ecosystem for the foreseeable future. And I decided to leave GS and jointly with Michael and Alec, two of my co-founding partners, to launch Nickel Digital. What we do, Nickel Digital is a full-service asset management house specifically designed around digital asset space and providing access to this market in various forms, starting from market neutral arbitrage and going all the way to directional exposure to this market for those who are willing to capture growth of this market. Now, what we realized recently through a number of our interactions with our clients, as well as survey we did recently, that for as many as 70% of respondents in our conversations, security of digital assets, implying how do you hold crypto assets in your portfolio, is an area of concern. And certainly it's not a straightforward, it's not a kind of, it's not a straightforward way you hold these assets. It's very different to equities, fixed income, and other classic traditional instruments. And from here, we decided that it was worth putting together a conversation around security and share our knowledge of this market. So if we start from the very basic, and I apologize if for many of you it would be too kind of familiar, but it's worth perhaps stepping way back and see where is the risk of holding these assets. So first things to say, despite multiple screaming in the press and multiple examples of people losing their Bitcoin or other digital assets, we have to differentiate between two levels. Level one is the protocol level, specifically how the blockchain is organized. And Bitcoin has been in existence for the last 12 years, since January 2009. So on the protocol level, it was never successfully hacked. So it's impressive how powerful and well-designed is this piece of software. Microsoft Windows requires patching every 3 months in order to keep it alive. Blockchain has been around, Bitcoin blockchain, for 12 years. Now, where the risk is really...
13 almost.
Say it again?
Almost 13.
Almost.
We're getting up on the 13th anniversary.
I think it was 2009, right? So it's
2008, the paper was published.
Published in October 2008, that's correct.
Yeah.
So where the risk is really is in the second level, what's called last mile, the way this asset is held by the investor or the end user. And that's where if the private key is compromised, i.e. somebody gain access to this private key or the private key is lost, that's how this asset becomes non-recoverable. Indeed, the complexity of private key is such that you cannot guess this number ever. if it's lost forever. From that perspective, if somebody takes control of this asset, it also has, blockchain is designed around irreversible structure, one-way street. From that perspective, putting security around private key is what we are dealing here with. David, anything to add here?
No, I mean, I think, you often have sort of the human factor as the greatest failure point of any security system, and Bitcoin is no exception.
Absolutely. Yeah, if we look on the basics, how you can hold a key, the private key, right? There are a few options. First is you trade at an exchange and you temporarily surrender your private key to the exchange. Exchange is in control of this key. Now, the risk is if exchange is hacked and private key is compromised, as we said, it's a non-recoverable. Somebody now controls your wallet, just transfer it from your wallet to his or her own wallet, and it's done. The alternative to that is software wallet. Essentially, when the private key is kept on your device, usually it would be a mobile phone, an application on mobile phone which controls this asset, this key, or your personal computer. So this is slightly better because key is isolated from the exchange. However, there is still a risk that if this device is lost, compromised, password is gone, then the asset can be lost. The next step is HSM, which stands for Hardware Security Model. Essentially, this is a specifically designed piece of hardware which holds your private key. That certainly improves dramatically security. However, there is still vulnerability to physical loss of this device. And whenever it's connected to the internet, it can be compromised through the malware and other hacking attacks, right? And from here, we're moving to the next two things which are going to be looking much closer. One is called key sharding. It's a structure whereby the private key, and what is private key? It's 64-digit long alphanumerical code, right? If you can split it into a few pieces and then distribute these pieces amongst several parties involved, you are diversifying the risk. You are eliminating this single point of failure. And we'll discuss there is still problems with that. And then ultimately, we're going to go into secure MPC, which stands for multi-party computation. So if we look as to how key sharding works, the idea here is, as we discussed, the alphanumerical code is broken, for example, in one of the scenarios, into three forms, into three pieces. One of them is given to investment manager, second to an independent custodian, and here it's important, it has to be an independent party, and third to an independent fund administrator, if you are running a fund, as we do, for example. And now you need these parties to cooperate in order to sign a transaction. Any single standing party cannot exercise full control over the asset. And that's important because you might have heard a situation with Quadriga in famous exchange in Canada, with the guy who was in control of the exchange disappearing with device at which he held the private key to the entire holding of whatever was $200 million of this exchange. And the risk here was single point of failure. Someone has the full control. Now, when you distribute between few parties, you now require at least two of them to sign the transaction. One of the questions is, why not all three to be involved? And the thing is that if you require all three parties to be present around a virtual table to co-sign a transaction, then you become a hostage of all three parties surviving in perpetuity. And if one party is missing, then you cannot control your asset. So in this model, when you need only two keys, you are far more resilient in ensuring long-term survivability of this asset. And essentially, in this situation, you can afford one of the party to go bust, and you can still have two other parties co-signing the transactions and moving asset to a safer place. By the way, by the same token, if we as an investment manager would do something which is not part of our investment playbook, then fund administrator would detect that, and jointly with the custodian can withdraw funds from us and return these funds to the investor. And to me, this is the ultimate kind of accountability of all parties involved. But what is important under this structure, in order to gain control over the wallet and over the account, a potential hacker has to simultaneously hack multiple organizations which are sitting on different platforms in different locations, and it has to be done in a very short period of time, which certainly dramatically improves resilience of this system and its kind of safety against attack. Another question which I'm being asked very often is like, how on earth you can have only two parts but recreate the entire master key, which ultimately controls the asset? And here, there is an interesting piece of math underlying, which was invented by Adi Shamir. It's a very famous Israeli cryptographer. And the way he approached that is, if you have, in a base case scenario, let's go from the basic. If you have one dot, 1 point A, you can put a number of lines through this point A. As a matter of fact, indefinite number of straight lines. But as soon as you add second point B, then these 2 points, they deterministically define this line. There cannot be any other. Now, these 2 points define the ultimate function. If you add a third point C, it doesn't add value, but it belongs to this line. Now, actually, you can either combine points A and B, or C and B, or A and C. Any of these combinations would still define this line. And that's how 2 parts are sufficient to recreate the entire ultimate equation. By a similar token, if you have a more complex structure whereby there are not 2 signatures, but for example, you can do N out of M. Again, it's a more complex structure, but logic is the same. If you have points A and B, you can draw an indefinite number of parabolas, right, for these 2 points. But as soon as you add the third point C, you immediately define this parabola in the only possible way. Now you can have a fourth point D sitting and running across this line, and that's how its N out of M will be sufficient to sign a transaction. So the number of points which are required for signature is called minimum threshold required, whilst the M is the total number of shares distributed amongst participants. David, would you like to add here anything before we move to single point?
I mean, you know, so the basic idea is that you have no one single point of failure. You know, like the old Cold War movies, like the Matthew Broderick movie War Games. They show they want to launch the nuclear missiles, and 2 people need to put their keys in at the same time and turn it at the same time. It's a more sophisticated version of that kind of security, that you can't just have one person to steal all your money out of your wallet. You have to have several different people working together to authorize something. And that's a critical way to add security around what we know is the biggest failure point, which is the human factor.
Mm-hmm. Yeah, absolutely. Now, with this system, however beautifully it's designed, there is one flaw. And that flaw is whenever parties have to put together their parts of the key in order to recreate the master key for signature, for that fraction of a second, these parts may need to come together at some server in order to sign a transaction. And that specific point of time may be a kind of single point of failure. If the server is compromised in that very second, then somebody may gain control over the private key. And for that reason, whilst the system is well designed, it has unfortunately this structural error. Now, how this can be approached is actually the answer to this is MPC. So MPC stands for Secure Multi-Party Computation. And the logic here is you have the same number of parties involved whatever n out of m, which are required to sign a transaction. And then whenever the transaction is initiated, for example, by us as an investment manager, then this transaction goes to the next party, and the next party would be independent custodian. From there, it goes to the next party, administrator, and so on. And whilst I can demonstrate that I have a part of the key which requires for this signature, I can confirm this to you without revealing the full information. And for that reason, it's called zero knowledge proof protocol. We can confirm to each other without showing the full depth of information. What it means that ultimately we are getting a transaction signed, but at no point of time, nowhere in the world, nowhere in the universe, this key is ever assembled, which means there is nothing to hack because this information is never held together. And the easy way to demonstrate that how we can communicate without revealing full information is so-called millennial problem, which was originally described in 1980s, I believe. And the logic here is as follows. If party A, or so we have three parties, right? And what we are trying to achieve is to calculate what is the average salaries of these three parties. And yet these three individuals are unwilling, for a good reason, to disclose their salaries. But question, can we collect information and arrive to the conclusion without showing the full information? And how it can be done, that party A takes his salary, his or her salary, adds some very abstract number, randomly generated, for example, $755,456, and then passes to the next party this number. For the next party, this number means nothing. It's an inflated amount, but that was the purpose, right? And we're not revealing the full information. Then party B would add to the number they received their salary and pass to the next party. Next party will do the same. And ultimately, the originator of this transaction gets a certain number. And of course, this number contains 755,000, which was kind of added. So what we have to do now, subtract this number back and then divide this number, whatever we received, by 3. And we have arrived to an average salary amongst these three parties without anyone revealing this number. And that's what creates this beauty of computational math without the need ever to reveal full information. MPC is called to be a holy grail of both usability and security. And for a good reason, because we can achieve flexibility without compromising ever the important pieces of information. David, would you like to add anything here?
Yeah, I mean, you know, the way to think about it is like demographics, right? So if I know your address, where your house is, then I know a lot about you. If I just know the zip code that you live in, then there's you, but there's also hundreds of other people in your same postal code. And so I can't tell that you're you. Your privacy is preserved, but there's still some useful information that can be extracted from that abstraction. So a lot of zero knowledge proofs are built around this idea of abstraction, where you get to some level of useful knowledge while still obfuscating the underlying data.
Yeah, exactly. And with MPC, we finally achieve this structure whereby it avoids any single point of failure. For that specific reason, this has become now perhaps a golden standard in cryptography, and specifically used by advanced custody solutions in crypto space. Right. From here, we can explore how custodians can eliminate a counterparty risk. And in our case, we have dual custodyship, one with Fidelity in the US, and second with Copper here in London. And Copper essentially developed perhaps the most advanced in the world approach to handling digital assets. And one of them is so-called off-exchange settlement. The logic here is, as a trader sometimes you have to be exposed to other exchanges, right? Because that's where the opportunities are. You have to temporarily have your assets placed there. Now, the question, how do you eliminate this counterparty risk? And the way Copper developed that is as follows. You, as an investment manager, you hold all your assets in a cold storage controlled by the custodian. Now, from here, whatever there is an allocation, say, of 20 million to a given exchange, custodian would notify that exchange that an amount of 20 million was reserved by Nickel to trade at a given venue. Now, exchange would allow all the trades to go through. And the idea is, if Nickel is on the right side of the trade, then exchange would send us, say, 1 million, which we won in this particular trade. If we are on the wrong side of the trade, we'll be sure, and essentially Copper on our behalf, to send 1 million, which we potentially lost in this transaction. And these settlements doesn't have to go on the monthly basis or weekly basis. It's actually done on the minute-by-minute basis. It can be done on the second-by-second basis. And essentially, you are creating this permanent settlement between parties involved without taking any counterparty risk. And the beauty of this system, if you can bring all your exchanges at which you are trading to this off-exchange settlement model, then you eliminated counterparty risk. That's what kind of the ultimate goal of that. And Copper really advanced in that. There are kind of more and more exchanges coming to this structure. And David, maybe you can share your insider knowledge on that.
Yeah. So before we get there, I want to pick up some of these questions from the chat. So there was one question that sort of calling back a little bit. Any other prominent cryptocurrencies or protocols that were hacked, or are they all based on similar protocol? Probably. So although Bitcoin has not been hacked, a variant of Ethereum was hacked. There's a fairly famous one called the DAO hack. DAO is a distributed autonomous organization. In that instance, Vitalik Buterin stepped in and actually forked Ethereum and basically unwound the hack. So there have been some prominent crypto hacks for sure, but Bitcoin has not been hacked. So different protocol have different vulnerabilities. And then there's another question which asked about the process of generating. So on this point of sort of the multi-party computation and key generation, what about the process of generating the key and distributing parts of it securely? Could that be a single point of failure? I mean, yeah, key generation and key management is certainly a point of failure, but that's one that's been recognized. So keys are generated using basically sort of a unique algorithm or hash on the data and generate some kind of unique digital signature. And then key management systems have been put in place because it is such a significant point of vulnerability. And so some of what we're seeing in the architecture around Copper is, in fact, a sophisticated approach to key management. So historically, it could have been a point of failure. With some more modern systems, the key management defect as it's currently understood where it was addressed. But of course, security is always an arms race. You build a better system, someone figures out a better attack, you build a better system, a better attack. And so you want to work with providers who have, and by the way, this is true of conventional financial services. Your bank account can get hacked. Forget your crypto account. And so everyone is just, you want to go with people who are investing in continuous security development and not to talk my own book, but part of the reason that I was attracted to Copper is the significant attention that the team pays to continuous technology investment.
Absolutely. Perhaps it's worth covering another point, which I'm hearing this more and more, these questions about quantum computing, specifically risks posed to blockchain. David, perhaps you're in best position to cover this topic.
Yeah, I mean, high level. So people like throwing around quantum because it's a very attractive headline for clickbait titles, right? So there's a wonderfully strange cartoon called Rick and Morty, which a lot of grown-ups watch, myself included, and they make jokes about how you can't just make something sound sophisticated by throwing the word quantum in front of it. But a lot of journalists like to do that. So quantum computing is an exciting area of computational development. There have been select examples of what's known as quantum supremacy, which is where the quantum computer is better than a conventional computing system, but they've been in very, very narrow use cases. And so quantum will eventually be something 10 years from now, which we'll be using, but it's not something you have to worry about tomorrow. And if and when it does get to commercial applicability in a broader, what's known as a Turing complete system, you'll have quantum defense. And so people, again, the more sophisticated players in financial infrastructure have already developed what's known as post-quantum security plans. And when quantum evolves to the point where it can actually break conventional 256-bit security, which is what most of us use, then there'll be a quantum defense to fight against it.
Mm-hmm. Okay. Another question which came from the chat. I'm just going for the Q&A. In MPC, what happens if one party becomes compromised, one share part becomes compromised or lost?
Well, and that's sort of an opportunity, right? So the idea of MPC is, as Anatoly was describing earlier, is you don't need 5 out of 5 keys in order to make the thing work. If you have some subset of that, like 3 out of the 5, for example, or 5 out of the 7, or you can set it. It's however you set your security. You can access the system, and then those existing keys can authorize creation of a new key system. So if one person loses their key, you're not in trouble. If half the people lose their keys, you might be in trouble, but that's mathematically improbable.
That's correct. Yeah. Another question is the energy use of Bitcoin mining has obviously been in the news recently. Whilst I recognize that renewables are increasingly being used to power mining activity, this surely is a significant opportunity cost given the hugely increased power requirements for real world activity. I'm happy to take this question. Interestingly, that when the reference is made to an enormous amount of energy required to maintain viability of Bitcoin, for example, that's not necessarily true, because the system would perfectly survive with 1/10 of this energy committed to the network. Really, it doesn't require this mining power and hashing power for long-term survivorship. Now, the reason we are spending as much energy as we do is really driven by the human nature, right? There is an invisible hand of market which drives new and new miners to enter this business, because ultimately it is a high margin business, specifically when the prices go through 50K. Ultimately, the operational cost will rise to close this gap, but when the market is on the move, certainly the opportunities are there. So what I'm trying to say that the system is not hungry for this energy. It's really driven by market forces. David? How can we build argument around that?
Well, I mean, so first of all, I'm less pessimistic about the future of Bitcoin and renewables. I think there are a lot of people who are trying to get more mining handled by geothermal, solar, other non-polluting sources of energy. I also note that there are a lot of efforts to create more energy efficient algorithms. So I think these are solvable problems.
Yeah. Well, actually, even if you look on the structure of consumption, I think a Cambridge Center for Alternative Finance named 74% as share of energy use, kind of a green energy use in Bitcoin mining. And if you think that makes perfect sense, because ultimately this is a number game, and the operational cost, i.e. energy cost, what matters and defines the level of profitability of individual miners. So from that perspective, they are driven for cheaper sources of energy. And in China, which still remains the largest mining center in the world, 65% roughly of hashing power originates in China. The reason, if you look on the map of China, it's really concentrated around areas with significant presence of hydro power stations. And a number of them, there was an overbuild in certain areas of China. And that's where the miners are concentrating, because they can offtake this energy in a relatively low cost. Another significant source of energy became really kind of these geothermal sources. Iceland, for example. Interesting that electricity is not transferable. You cannot easily transfer it from island to the mainland Europe, right? It should be consumed locally. From that perspective, miners would kind of place their equipment next to the geothermal stations and just offtake this energy. And I think the biggest, latest evolution has been flare gas. So you have Texas with a number of new oil drilling structures. And as a side product of oil drilling, you have flare gas, which normally would be either released or just burned. Why you wouldn't put this gas into a pipeline and transport it to the main center of consumption? The answer is cost. It's impractical to build this pipeline for the temporal structure of oil extraction. From that perspective, if miners were to put, and this is becoming a trend, containers full of mining equipment next to these oil extraction fields, they can offtake this gas, which otherwise would be wasted anyway, and they would convert this into electricity, consume on the spot within the mining process. The only thing they need really is the internet connection. And with Elon Musk bringing us space links, you have direct communication via satellites. You are connected to the internet. So basically, these new trends are natural evolution, I think, of Bitcoin. And certainly kind of since inception 12 years ago, that wasn't necessarily the primary objective of Bitcoin. And for a good reason. The primary focus was security. Because back then, and even until these days, you have to survive in a very hostile environment. You have hackers who are trying to break the system. You have government agencies who may not be necessarily pleased with alternative monetary systems emerging next to fiat systems. So basically, the desire to kill this system was always there. And from that perspective, security was the paramount importance. Now, after 12 years of successful existence and actually growing into trillion large asset class, its natural evolution will be more ESG compliant, more kind of environmentally friendly modus operandi.
There's a question in the chat about counterparty risk, and if it's just getting centralized in copper, and the short answer is no. In fact, the copper system will work even if a meteor hit copper's headquarters and nuke the servers. That's the benefit of the design of these multi-party computation systems if they're properly implemented. You want to answer this? This looks like more a question for you, Anatoly, of what cryptocurrencies do you support for off-exchange settlement?
Right. Off-exchange settlement in this particular case is driven by infrastructure developed by Copper. Today, there are 7 exchanges. Another 5 or 6 are on the onboarding stage. And ultimately, the idea is to bring kind of the whole spectrum of exchanges to that. But it's a process. It was launched last year. And again, it's kind of evolution of this. So increasing number, not yet all of them. But which exactly you can find on the Copper website. I think it's a public information. Any other questions coming? I think natural question which we are getting very often is regulatory framework, because in this conversation we have addressed technical part of security, but then the question is how the whole legal system is friendly or hostile towards this asset class. David would like to share your views on that.
Well, I mean, so, you know, it's, again, popular to sort of oversimplify and say that, you know, regulators hate crypto or regulators love crypto, or, you know, there's hostility around it. You have to ask in which domicile, and you have to think about where you are operating. What I have seen is that there's a more sophisticated response emerging around how people are thinking about the asset class. And that creates opportunity. And frankly, it is getting more institutional in nature. And that's one of the things I find encouraging about the overall category. When you have BlackRock jumping in, when you have, you know, Tesla allocating a significant portion of their cash to crypto, when you have MicroStrategy placing a big forward trade around Bitcoin, it's turning into kind of a legit commodity. Let's call it that, if you would. And regulators are treating it as such. Where you're seeing people get into trouble is where they try and skirt the law, and pretend that laws of gravity don't apply. And so, oh, well, we don't need to do AML KYC because it's different. It's magical. It's not magical. You still have to obey the law. And when you do, then there are great opportunities to participate. You want to build on that?
Yeah. Well, my view of that topic is that regulators have moved away from idea of killing Bitcoin and crypto ecosystem, and in favor of regulating, kind of embrace, regulate, and tax, and put proper KYC framework around that. And honestly, this is by far more reasonable behavior, because first, if you look on the technical side of the system, how can you kill Bitcoin? You have to shut down all 10,000 individual nodes, which are spread across 120 countries. If you shut down only 9,000 of them, system will perfectly operate. If you shut down 9,900, system will still operate perfectly fine. It requires just a handful of servers in order to maintain this distributed ledger. So basically, unless you have a power to simultaneously kill either internet or shut down all 10,000 computers, it's going to be a futile effort. So essentially, a part of regulation, you need an enforcement side, and enforcement unlikely to succeed. From that perspective, you better regulate it. And what we've seen in the US in the recent months, I think is extremely telling and encouraging. First, in September last year, OCC, Office of Currency Controller, came up with a regulation which allowed US commercial banks to engage in custody of digital assets. Now, that was kind of a very interesting piece of information, because you wouldn't expect from regulator to allow 8,000 banks to engage and then jump out of the bushes 2 months later with the screaming, now we're prohibiting this. Why would you create this distress to your own banking system? And that was the first preview of what were to come later. The next significant movement was in January this year. On January 4th, the same OCC comes with a new piece of regulation, which now allows commercial banks, in addition to custody digital assets, also get formally involved with stable coins. And essentially, what's allowed here is a transfer of value as a financial value alongside SWIFT, FedWire. Now you can use blockchain for the same purposes. And that's a significant way forward, right? And in addition to that, commercial banks were allowed to become part of the distributed networks as one of the nodes, participating nodes in these structures. And to me, this is a very structural move, allowing commercial banks to integrate themselves into distributed financial system. And I believe that's exactly where the market is moving. And it looks like US regulator accepted that this is the way forward rather than denying the existence of crypto space. And by the way, in the new structures, when central banks are coming with digital currencies, commercial banks becomes to some extent irrelevant, because if you think how central bank digital currency works, it's a direct communication between issuing authority, being central bank, and the end user, all of us. And the beautiful example telling example was how China conducted their experiment last year. So for 6 months, they ran experiment whereby central bank issued certain amount of newly created tokens, digital yuans, right, to the end users. You would get this in your wallet, and then this amount can be spent over the next 3 months. You cannot store this amount as a saving. You cannot use this for the playing on the stock market, inflating price of local Tesla, because this is prohibited under restrictions embedded in this wallet. But you can spend this amount on several services and goods. Essentially, central bank stimulates certain parts of the economy to kind of channel funding towards that. But if you can see in this structure, commercial banks as the intermediary do not participate. And that what creates the risk that the commercial banking network, the way we knew it, will become irrelevant in the new reality. What US is attempting to do is to integrate these commercial banks into the new structure by being participating nodes, using crypto payment rails. Otherwise, these institutions will not be in demand 10 years from now. So in conclusion, I think we are seeing a general positive perception of this space by the regulators, rather than an continuous attempt to ban this space. Okay, any other questions?
Well, there are a few more pouring in, so
yeah. Would you like to take any, David?
Oh, you're giving me a choice. Well, I mean, so you know, there's one question that's asking: Are exchange traded products a tool to outsource the crypto risks to market makers at the cost of liquidity? I mean, you know, look, no more so than trading on the New York Stock Exchange around shares of Apple. You know, it's like, you know, market makers are a good and necessary component of a mature financial system that involves exchanges, and they provide liquidity by definition. That's their role, and so yeah, if you're going to use an exchange, you're gonna look to enjoy the benefits of the institutional infrastructure that's around it. So I would call that evolution, not devolution. And I would say this is an opportunity to actually see crypto starting to offer the same kind of liquidity and power that you get in other kinds of commodities and securities.
Right.
You want to take one?
There's a question: what is your process of trading ERC20 tokens, say on Uniswap? If I comment on that from the point of view, what we do today as Nickel, our flagship fund is a market neutral arbitrage. From that perspective, to maintain market neutrality, I would require a corresponding future market on top of each position we're holding in the fund, which means we cannot go wild on any coins out there in existence, and there are a few thousands of them, right? So as of today, there are roughly 12 crypto assets which have corresponding future, and we require this market to hedge our position to maintain market neutrality. Now, Uniswap is not yet there, but it will appear at some stage and may become part of our trading environment. Where Uniswap will come, perhaps kind of more day-to-day operations, is in a new fund which is being launched today. In addition to what portfolio we have in existence, there was an increasing demand for altcoin fund, essentially everything outside Bitcoin. And we are looking at this process from not a technical top 10 positions, but rather looking in the underlying logic of each asset, of its kind of raison d'etre. What's its use case, how it's positioned in the market, what is the competition like, and so on. Uniswap certainly is a candidate for that portfolio. It should come live next month. So essentially, it will be integrated in our trading. As of now, we do not trade it.
Now, I see there's a question from Alex Ferguson. Do you believe that banks are losing their role in money creation? So this is actually one of the biggest risks of central bank digital currencies, or CBDCs. That if they are, and there's a wonderful paper that a good friend and collaborator, Alex Lipton, has written about on the theory of monetary circuit, which elaborates on this concept of basically, in a world of CBDCs, there's a risk, if they're not designed correctly, that you eliminate the creation of money. And so the way that, for example, the central bank of the PBOC, the Central Bank of China, is getting around that is they're doing it only wholesale. So Central Bank of China sells the digital RMB to the retail institutional banks, who in turn provide them to the market, and it opens up the creation of money. And this is a more technical discussion, but I'd encourage you, if you're interested in this topic, to take a look at Alex Lipton's paper on monetary circuit. So the short answer is some CBDCs and independent cryptocurrencies like Bitcoin run the risk of eliminating the role of banks in the creation of money, and others do not. And let us remember that a bank as a concept serves an important role in supporting the stability of financial ecosystem. Incumbent banks today are a mixed bag. Some of them are positive actors and some of them not so much. But conceptually, the idea of having banks serving as sources of liquidity and financial intermediaries is actually, in my opinion, a good thing. It's just, you need to evolve, and a lot of them haven't.
Okay. There is another question on store of value versus mean of exchange in relation to cryptocurrencies. Interesting. This is dialogue, a conversation which comes very often. And my standpoint on Bitcoin is as follows. It perhaps slightly confusing when we generally call this space cryptocurrencies, because when you call Bitcoin cryptocurrency, the expectation is it should be an efficient mean of exchange, and we all know that it's not very efficient in that respect. If you look at the base protocol, it can process roughly 3 to 7 transactions per second. If you compare this to Visa International, a very old technology dated 1970, Visa International can process 56,000 transactions per second. It's difficult to compete at this stage. But what I'm saying, it doesn't have to, because the fundamental reason for Bitcoin, or not reason, kind of value added, is really store of value rather than mean of exchange, at least at this stage. And store of value comes from the unique monetary policy, which is inbuilt on Bitcoin protocol level. Specifically, you have a limited number of coins ever to be issued, 21 million. You have 89% already in circulation, with the balance of 11% to be issued over the next 120 years by design. And you have a very predictable number of coins released every year, per block, right? As of today, we're going through 6.25 coins per block. And I can tell you how many coins going to be in circulation, say by November 2032. Can anyone tell me how many dollars going to be in circulation by November 2032? The answer is no, because US dollar equal to any other fiat currency. The issuance schedule is controlled exclusively by the central bank. And that's what creates lack of transparency, right? We are dependent on those institutions. And we can understand even why they would inject this liquidity. But from the point of view of investors who are protecting their capital, they would love to get a different monetary policy. Suddenly, Bitcoin happened to offer this A, transparency, B, strictness to this issuance schedule. And ultimately, there is a thing called scarcity. And scarcity is the only reason why, say, traditional gold is worth anything, because there is a scarcity to this asset. If we were to discover a new mine, a gold mine, which has 5x amount of gold which is currently in existence, and unintentionally we were to disclose this information to the world, I can tell you what's going to happen to the price. It's going to collapse, because suddenly gold lost its scarcity overnight. Coming back to Bitcoin, it has this inbuilt scarcity into it, and that's what drives demand for these assets over the last 12 months. And essentially 2020 became this pivotal point when many investors arrived to this conclusion they have to protect their capital against forthcoming inflation and against currency debasement. This unique monetary policy of Bitcoin just became one of those which attracted attention. And this is store of value, as we discussed. Somebody I hear the pushback that it's too volatile to be a store of value. And then the interesting observation, if you look on gold, which is a typical store of value, right, widely accepted, gold peaked in September 2011. The price at the time was just under 1,900. Where are we today? We are below this price. 9 years later, we cannot recover previous height on the gold price. Even more so, from September 2011 all the way to 2015, over 4 years, gold collapsed by 45%. And yet, we consider this to be perfectly fine for gold as a store of value. From that perspective, Bitcoin is a volatile asset. It will remain volatile, but this volatility does not undermine its function as a store of value. And by the way, I'm not Bitcoin maximalist by any stretch. I'm just kind of observing the logic of this asset and just cannot help myself being bullish on what's happening on the macro environment and how Bitcoin can deliver value in these particular circumstances. Yeah, and another thing interesting that classical currencies have to correspond to three functions, right? Store of value, a mean of exchange, and unit of account. And unit of account, certainly not many people still think in Bitcoin, but I know people who kind of their logic, their accounting system in their head is Bitcoin. Everything else is a relative value to Bitcoin. I wouldn't be surprised if a few years from now, more and more people and possibly even corporates start to think in that space. Again, I'm not Bitcoin maximalist. I'm just thinking there is a logic behind that. David, any other questions?
Only that I would not want to pay my workers in Bitcoin. It's too volatile. So I think that it has attractive characteristics as an asset class, but it's not something that I would want to use for ensuring people have stable wages week to week.
Correct. But possibly a share of salaries, say 10%, can be perfectly fine. Again,
I mean, variable upside is another story, right? If you're providing someone an incentive in the form of long-term opportunity, yes. But if someone is a minimum wage worker, I would not want them getting paid in Bitcoin.
Mm-hmm. Yep. I'm trying to find, there are a number of questions. Some of them we answered, some we did not. But I didn't want to miss anything.
We have time for maybe one more question.
Yeah. So we've answered banks losing money.
Yeah. I mean, we do a fast one, which is Ravi is asking about. There's many different kinds of money out there: bank deposits, cash, bank reserves, central bank. Could central bank digital currencies not simply be added to this list, thereby making private sector secure digital currencies like Bitcoin irrelevant? So the answer is yes and no. So I do think that central bank digital currencies will be added to the list. And I do expect Bitcoin will still be around in 5 years. So, we're just going to see sort of a federated answer or a heterogeneous answer as to what money looks like 5 years from now.
I can add to this point. Central bank digital currencies, whilst certainly getting some greater efficiency in form they are distributed between central banks and the end user, being population in a given country. These, by the way, it's going to be based very likely on blockchain, right? And going to be using this efficiency of crypto payment rails. However, there's going to be one fundamental flaw still embedded in central bank digital currencies. It's a kind of, it's an asset which is controlled by one entity. An ability to inflate digital yuan, digital dollar, digital euro still remains there because this is a centralized control. Coming back to Bitcoin, it's a non-discretionary asset where no entity, no person in the world has the ability to inflate this asset. And that's its value proposition. And because of that, it's unlikely to be displaced by the incoming central bank digital currencies. It's likely to coexist because it kind of delivers on the completely different value proposition. Yeah. Perhaps, we're going to...
I think we're at time here, but
we are at time.
We appreciate the opportunity to participate. Thank you, Anatoly, for inviting me.
That was certainly a pleasure. Many thanks, David, for your time. And last thing, I'm gonna direct our participants on our website, Nickel Digital. We have a learning center, which is a number of papers and publications collected over the last 12 years. From the very first paper on Bitcoin, published in 2008 by Satoshi Nakamoto, and all the way to 2020, 2021, including Paul Tudor Jones' paper on Great Monetary Inflation, which I think was one of the fundamental piece of information released in May 2020, and as well as a piece by Neil Ferguson on the unfolding monetary inflation. And I encourage everyone to log in and go through these papers, specifically Neil Ferguson, who is a historian, financial historian, came up with a very interesting article in the end of last year, essentially saying we are going through an unprecedented monetary revolution. Very few of us can comprehend the depth of this revolution. And what he is seeing that Bitcoin is winning this revolution. It may be a very bold statement, but at least it's interesting to see the logic displayed by Neil in this piece. On that, I would like to say thank you very much to everyone. Here are our contacts, David's email address, mine. We will be very happy to expand this discussion. Many thanks and goodbye.
Nickel is a firm that combines an understanding of digital assets with many years of traditional financial expertise with technology smarts.
Nickel, a group of investment professionals coming from traditional finance, namely JP Morgan, Goldman, Bankers Trust, Deutsche Bank. So combining this experience from the conventional finance and technical expertise, we're pulling these resources together to create a platform via which investors can access digital assets market.
So in order to build a successful manager in the digital asset space, you need three types of expertise. You need experience of trading traditional financial markets. You need experience of trading the nascent digital markets. And on top of that, you need the computer science experience in order to build procedures around your custody and movement of assets, and just to build a trading system that will effectively execute those trades at the exchanges. I think what's unique about us is that at the founding partner level, between the three of us, we cover all three of those. We have 6 years of experience in traditional financial markets. We have 20 years of experience building our trading software. And now we have over 10 years of experience of trading crypto specifically.
The market is ready for custody solutions that have been developed by Nickel. Before, crypto custody was insecure and unreliable. Now, with the solutions that our partners have developed, it's secure, insured, trustworthy. In short, it's ready for institutions.
The market has evolved over the last few years to offer a secure way to access the market. If you think
few years back, people would use what is called self-custody to custody digital assets. We believe that was not really an institutional way to access the market. Today, we have these solutions in place.
The initial investment solution we brought to the market is the Digital Assets Arbitrage Fund. It trades strategies like future spaces, calendar spreads, volatility arbitrage, a whole number of market-neutral, sophisticated strategies. The reason why we began with that was to prove to the market that we can build an effective execution platform where we can easily manage the risks of these sophisticated market-neutral strategies.
We chose to do this first because it's the hardest thing to do. All the other products we can launch after this will be simpler for us to implement. The second product is the Digital Gold Fund. That is a long-only Bitcoin solution that's secure, efficient, and liquid.
Digital gold is a natural extension of the expertise we've gained trading the arbitrage fund. We can execute trades much faster and much cheaper than anybody else in the market, putting us in a very advantageous position to provide this long-only product.
Digital assets are a huge opportunity to transform finance, giving investors access, control, and liquidity in a cost-efficient way.
Digital assets is a standalone asset class, like venture capital, private equity. And from that perspective, over time, it will make way into portfolio allocation of pretty much every institutional investor.
I think our goal here at Nickel is to build a one-stop institutional shop for all of your crypto investment needs. We think that the market, as it develops, will provide a lot of democratization of access to different types of instruments out there, be it real estate, be it private equity. We think we will provide the technical solution to trade all of those markets.
So we believe digital assets offer new and exciting chapter of finance, essentially offering greater liquidity, greater transparency, and greater efficiency of financial flows.